This podcast is for informational and entertainment purposes only and should not be taken as financial advice. Always your own research before making any investment decisions. Hey guys, how's it going? Welcome back. So today I'm doing something I've honestly been putting off for a while now, and I think a lot of you are going to this interesting because I know many of you hold the same position I do. I'm taking a hard, honest look at my JEPI position, the JP Morgan Equity Premium Income ETF, and asking myself a question that's been nagging at me for months. Should I be in SPYI instead? Now, let me give you the full context here. I currently hold about 1,933 shares of JEPI. The position is worth roughly $115,000. My average cost basis is $55.31 a share, and right now it's trading at $59.44. So I'm up a little bit on the price, which is nice. And this position is generating about $9,100 a year in income. I've collected almost $12,000 in total dividends from this thing I opened the position. So it's been working. It's been doing its job. But here's the thing. I keep looking over at SPYI, the NEO's S&P 500 High Income ETF, ticker SPYI, and the numbers are getting harder and harder to ignore. And I feel like I owe it to myself and I owe it to you guys to actually break this down properly instead of just sticking with JEPI out of comfort or loyalty or whatever you want to call it. So let's get into it. Let me walk you through this comparison piece by piece. First, the number that everyone cares about, yield. JEPI is currently sitting at about an 8% yield, paying around $4.74 per share annually. SPYI, it's at nearly 12%, $6.16 per share. That is a significant gap. We're talking almost 50% more income from SPYI on the same dollar invested. If I took my $115,000 in JEPI and moved it into SPYI at today's prices, my annual income from that position would jump from about $9,100 to roughly $13,400. That's over $4,000 more per year, guys. Now, yield alone doesn't tell the whole story, and I've talked that in previous episodes. We all know chasing yield can get you in trouble, but this isn't some fly-by-night yield max fund promising 140%. This is a legitimate, well-structured ETF from NEOS, and return numbers back it up. Since SPYI launched in late 2022, its return, and I mean total return, price appreciation plus all distributions reinvested, has been around 63%. JEPI over same period, about 45%. That is an 18 percentage point gap. And that's not just yield, that's total return. So even when you factor in price movement, SPYI has been outperforming. Now, I want to be fair to JEPI here because there are some real differences in how these two funds work under the hood. And this matters a lot depending on what kind of market we're in. So let me walk you through the strategies. JEPI does something a little unusual. It doesn't just buy the S&P 500 and sell calls against it. Instead, the JP Morgan team actively selects a little of low volatility, high quality stocks. Think defensive names, value-oriented picks. And then they sell what are called equity-linked notes, or ELNs, to generate that premium income. These ELNs are essentially structured products tied to the S&P 500's upside. So stock selection is different from the index, and the income mechanism is different from a traditional covered call. SPYI on a much more straightforward approach. It holds a portfolio that closely replicates the S&P 500. So you're basically getting full S&P 500 exposure. And then it sells call options on the index to generate income. It's a more traditional covered call strategy. And because of that, SPYI tends to track the S&P 500 much more closely during rallies. And this is a key point. When the market is ripping higher, like it has been for most of the last couple of years, JEPI's defensive stock selection actually works against it. It's holding these lower volatility names that don't participate as much in the upside. Meanwhile, SPYI is holding the actual index, so it captures more of that rally before the call options cap the gains. That's a big part of why the total return gap exists. And this is important. When the market sells off, JEPI's approach actually shines. Those defensive, low volatility stocks tend to hold up better in drawdowns. If you look at maximum drawdown numbers, JEPI has only pulled back about 13.7% at its worst, compared to SPYI, which has seen drawdowns closer to 17%. So in a nasty bear market, JEPI is going to feel a lot more comfortable to hold. And frankly, that matters when your portfolio gets to a certain size. When you're talking about 100,000 plus in a single position, a 17% drawdown means you're watching almost $20,000 disappear. With JEPI, that same drawdown would be more like 15,700. Still painful, but a meaningful difference. All right, now let me talk about the thing that really caught my attention when I started digging into this. And honestly, this might be the most important factor for a lot of you: the tax situation. SPYI uses what are called Section 1256 contracts for its option strategy. And without getting too deep into the tax code here, what this means is that the gains from those options get a special tax treatment. They're automatically split 60-40 between long-term and short-term capital gains, regardless of held the position. So 60% of those gains get taxed at the lower long-term capital gains rate, and only 40% gets taxed at your ordinary income rate. JEPI's distributions, on the other hand, those equity-linked note premiums largely come through as ordinary income. That means they're taxed at your full marginal tax rate. If you're in the 32 or 37% bracket, that is a massive difference in what you actually get to keep. SPYI also has some distributions that qualify as return of capital, which means they're not taxed at all in the year you receive them. They just reduce your cost basis. So when you look at the after-tax yield, the gap between SPYI and JEPI actually gets wider, not narrower. Now, I should mention, if you're holding these in a tax-advantaged account like an IRA or a Roth, this doesn't matter as much. Everything grows tax-free or tax-deferred anyway. But if you're like me and you have some of these positions in taxable accounts, this is a real consideration. All right, let's talk about the one JEPI clearly wins, and that's expense ratio. JEPI charges 0.35%. SPYI charges 0.68%. So SPYI is almost double the cost. On a $100,000 position, that's the difference between paying $350 a year versus $680. It's not nothing, but when SPYI is delivering 3 to 4% more in yield and better total returns, that extra 3 basis points in fees is pretty easy to justify. The net numbers still favor SPYI by a wide margin. Another thing I looked at: distribution consistency. Both of these funds pay monthly, which is great, but JEPI's distributions have been a bit more predictable month to month. SPYI can swing a little more depending on options premiums and market volatility. Some months it's higher, some months it's a bit lower. For someone who really depends on knowing exactly what their check is going to be each month, JEPI offers a bit more peace of mind there. That said, on an annualized basis, SPYI has been consistently delivering that 10 to 12% range, so it's not like it's wildly unpredictable. There's also the AUM difference, which is worth mentioning. JEPI is a behemoth, over $40 billion in assets. SPYI is at about $7.8 billion. Both are plenty liquid, but JEPI's massive size means tighter spreads and effectively zero concerns about the fund closing or anything like that. SPYI at nearly 8 billion is also very well established at this point. So I don't think liquidity is a real issue for either one, but JEPI does have the edge there. So here's where I'm at with my thinking. And again, I'm just thinking out loud here. This is what I'm working through with my own money. I don't think JEPI is a bad fund. I want to be clear about that. It's done exactly what it promised to do: generate steady income with lower volatility. And if we enter a prolonged bear market or a high volatility sideways market, I think JEPI would actually be the better choice. Its defensive stock selection and that lower max drawdown give it a real advantage in ugly environments. But here's the thing: we're in 2026. The market has been on a strong run. The S&P 500, ticker SPY, is sitting at $686. My VOO position has done extremely well. And in this kind of environment, SPYI's approach of holding the actual index and selling calls against it makes more sense to me than JEPI's defensive posture. You're getting paid more in income and you're capturing more of the upside. It's kind of the best of both worlds in a bull market. The way I'm leaning right now, and I haven't pulled the trigger yet, I'm still working through this, is to start building a SPY position alongside JEPI rather than doing a full swap. Maybe I start directing new capital towards SPYI and see how it performs in my portfolio for a few months before making any bigger moves. I don't love the idea of selling 1,900 shares of JEPI all at once and creating a big taxable event. That kind of defeats the purpose of the tax efficiency argument. Let me also zoom out for a second and talk about how this fits into the broader portfolio, because context matters. I'm not just sitting here with 115,000 in JEPI and nothing else. Our portfolio is sitting at about 1.32 million across all positions. SCHD is still the biggest core holding at close to 400,000. VOO is at 255,000. VTI is at 132,000. JEPQ, the NASDAQ version of JEPI, is at about 117,000, generating over 12,000 a year. And then we have the Bitcoin positions. BTI and IBIT together are around 175,000. So JEPI and potentially SPYI occupy this specific role in my portfolio. They're the S&P 500 focused income layer. The way I think about it, SCHD gives me dividend growth and stability. VOO and VTI give me pure market exposure and long-term capital appreciation. JEPQ gives me income from the NASDAQ side, and JEPI or SPYI gives me income from the S&P 500 side. Each piece has a job. If I were starting from scratch today with no position in either fund, I think I'd probably split it. Maybe 60% SPYI for the higher income and tax efficiency, and 40% JEPI as a defensive buffer. That way, in a bull market, the SPYI portion is doing the heavy lifting on income and total return. And if we get correction, the JEPI portion holds up better and gives me some stability. It's not an either or, it's a both and. One more thing I want to mention. I noticed I was looking at GPIX, the Goldman Sachs S&P 500 Premium Income ETF. That fund has actually had a 5-year price growth rate of over 23% with about an 8% yield. I haven't done a full deep dive on it yet, but it might be worth looking at as a potential third option in this covered call space. Something for a future episode, maybe. All right, so let me sum this up. If you're choosing between JEPI and SPYI, here's my honest take. SPYI wins on yield, 12% versus 8%. SPYI wins on total return since inception, 63 versus 45%. SPYI wins on tax efficiency in taxable accounts thanks to those Section 1256 contracts. SPYI tracks the actual S&P 500 better during rallies, but JEPI wins on expense ratio, 0.35 versus 0.68. JEPI wins on downside protection with a smaller max drawdown. JEPI wins on distribution consistency month to month. And JEPI has a much longer track record and massive AUM. For me, the move is going to be adding SPYI as a complement rather than a replacement, at least for now. I'll keep you guys updated on what I actually do. And if you want to see all these positions and the exact numbers I'm referencing, check out retireearlywithdividends.com. It's a free tool I built to track dividend stocks and monitor your portfolio income. Everything